And I mean, as service professionals, we always want to, tell the client that everything is going to go smoothly and that we're going to do, we're going to be better than everybody else in the industry and provide them the 110% service and white glove service and all that stuff. But I think it takes real strength and real professionalism to say that sometimes things do go wrong, and
Yes.
here's what we can do if that case arises.
Hello, everyone. Welcome to another episode of Level Up. Today, we are here with one of our brokerage's go-to mortgage agents, and that is Jacob Manishevitz from Outline Financial. Jacob comes to quite a few of our meetings just to keep us updated on the mortgage landscape, and he always has a lot of great information and resources to share. So I figured we'd bring him on to the podcast and chat a little bit further about new things that are coming up, what agents need to know about, and all that fun stuff. So welcome, Jacob. Thank you for coming.
Awesome. Thanks, Katie, for having me. Very excited.
Yeah. So maybe we can get started. I know when we first jumped on the call, you had started talking about the bond yields and how you've seen them go up, spike up over the last week or so. So I think that's some timely information to share with people. So what have you been seeing and what are you doing about it?
Yeah, it's a great question. And, like we were saying earlier, such exciting stuff. But I think for our purposes, it is, important to know. And the narrative, I think since the beginning of the year, in the first few weeks of January, we saw things start to pick up in the market where the commentary and the narrative, especially kind of by mainstream media, was that rates are coming down this year. Everybody's jumping back into the market. Things are going to get competitive again. And I think everybody got really excited for a hot 2024. And that's been the narrative up until very recently, when in the last week or so, we've seen bond yields jump up. And just for those who don't know, bond yields are kind of a prediction of where the market is going to be in a certain number of times. So we look at the 3-year bond yields and the 5-year bond yields, which are predictions of where the interest rates are going to be in 3 and 5 years. And it kind of preempts the Bank of Canada announcements. So when the Bank of Canada makes their announcements, they're looking at bond yields as well as a lot of other data to influence their decision. And it's kind of the market's expectation of where things are going to go. And bond yields had been steadily declining kind of through the last quarter of 2023, and fixed rates were coming down. We saw fixed rates come down about 1%, maybe even a little bit more, depending on the lender, over November and December and into January, and things were looking really good. And we were getting great discounts on our fixed rates for our clients as well. And then in the last week or so, we had a few points of data come out, like Canadian GDP was a little stronger than expected. Canadian employment numbers were higher than expected. And then the most recent US inflation numbers came up a little bit higher than expected as well. And all of that has pointed towards the Bank of Canada and the US Fed pushing back their rate cuts, the expected rate cuts that some people were forecasting for March or April or maybe May or June, and everybody was getting very excited about the first Bank of Canada cut. And now it's looking like those are going to be a little further down the road than we had expected maybe a month ago, because the economies are in the US and Canada are both performing a little more strongly than expected. And it looks like we are not going into a technical recession, because the last quarter of the Canadian GDP showed a little bit of growth, and technically 2 quarters of no growth is what is considered a recession. And we didn't actually see that in Q3 and Q4 of 2023. So our GDP grew a little bit, showing that our economy is stronger and pushing back rate cuts a little bit further. So it's not great news. And what we're doing right now, like Katie and I, we were discussing just before we started, was booking in our pre-approvals yesterday and today has been all about scrambling to book in our pre-approvals for 120 days out from today, because with this upward pressure on bond yields will likely come with increased fixed rates with most lenders, which we're expecting to get announcements and notifications about that like any time now. So we're scrambling to get our pre-approvals in so that we can hold those rates for our clients through the spring market, through the next 120 days, so that now these rates aren't expiring until June, and our clients can capitalize through the spring market, regardless of what happens with the bond yields and with interest rates and with the Bank of Canada announcements. If we do see volatility and a bit of a roller coaster over the next few months, which is looking like what's going to happen, we do have these, low early February rates locked in for them still. which can be very advantageous when you're
Yeah.
competing with somebody who maybe doesn't have that kind of rate locked in.
For sure. So in like, I don't know if you know the answer to this question, but in terms of difference between rates, like what are you thinking or expecting that, if people lock in now versus wait a few weeks and the rates or the bond yields go up, like what kind of a difference do you think there'll be?
Yeah, so usually when there's a rate change, we're looking at 10 to 20 basis points or zero point 0.1 to 0.2%. So if you
Okay.
had a rate at 5.5, you may be looking at 5.7 instead. It's not a huge difference. It could be $50 a month, $80 a month, depending on your
Yeah.
mortgage amount. But of course,
So,
these days
yeah.
every penny counts. It's especially with first-time buyers.
Yeah.
We really want to make sure we're getting the lowest rate for them because they need to budget, and that's why we're always looking at fixed rates instead of variable for them
Right.
as well. But it could continue like this, and we could see one rate jump and then another one. And the next thing you know, we're back to where we were in October or November of last year, where
Hmm.
rates were significantly higher than they are today. We're really we said we were in a transitional period for the
Hmm.
better, and now we're in more of a transitional period going in the different direction. How long it's going to last really remains to be seen. How far it's going to go, nobody can really tell. But ideally, it's just kind of we're on a roller coaster. We're kind of hitting the peak and maybe coming back down, and
Yeah.
things will kind of balance out maybe towards the summer.
Yeah.
But kind of the long and short of it is make sure your clients have their pre-approvals in
Yeah.
as soon as possible, because what's going to happen over the next few months is not something that's easily predictable.
Yeah. Do you see a world where rates could go back up or
Yeah,
go up? Yeah.
yeah,
Okay.
I think they could. It's quite possible. I think
Okay.
the Bank of Canada is probably as wary about raising rates as they are about cutting them. I think
Hmm.
ideally they'd like to keep it where they are and hopefully see inflation numbers come down even further before they do make their cuts. Right now, wage growth has been coming down, which is one of the things that they look at. It's just over 5% right now. They want to bring that down even lower because if wages are growing at 5% per year, it's hard to hit that inflation target of 2% per year
Yeah.
because people are continuing
Oh,
to have more and more spending power. So there's a lot of economic factors that they're looking at, and ideally those will start to level out and come down throughout the year. But the biggest issue is that the U.S. economy is really chugging along and is very resilient, and
mm-hmm.
we have to follow suit with them to a certain extent. And
Yeah.
a big part of that is that a lot of the average US mortgage holder is not impacted by interest rates as much as the average Canadian mortgage holder, because US mortgage terms are usually 25 or 30 years.
Yeah.
Your mortgage doesn't come up for renewal for 25 or 30 years. So
Mm.
it's not like they're seeing huge swaths of mortgages renewing every year, just like we are in Canada with people who have, 3 year and 5 year terms. Every 3 or 5 years, your mortgage is up for renewal. So you're going to be much more immediately impacted by any changes in interest rates.
Mhm.
And of course, credit cards and car loans, just like the U.S. consumer is affected on those fronts, but their mortgages, most people's largest expense, is not as impacted by Fed rate announcements, and so the Fed has less control over the U.S. economy than the Bank of Canada does in that respect. And
Mhm.
unfortunately, we do have to follow in lockstep with them pretty
Yeah,
closely because we don't want our dollar to fall too far behind.
exactly. So many factors at play, and if
It's a lot. It's a
yeah,
lot.
if people
Yeah.
are listening and are like, "What the hell is all of this?" I mean, it all plays into it, and, like, I think if you as an agent are kind of not even understanding, like, I think just for me, it was just trying to understand each piece of it individually, like, how does inflation impact things? How does GDP? And, like, you slowly get to be able to understand how the full spectrum really has an impact on things, but it can be a lot. And to be able to explain that to your client, I think that's where the value of a mortgage broker, a partnership with somebody that is able to explain this stuff better, obviously, than you are, is really important. So, like in terms of building your own business, what have you focused on, and how important is that relationship with the agent?
Yeah, for sure. So the majority of my clients do come from realtor referral partners, and I've fashioned my business in that way of making sure I'm supporting my realtor partners as well. It's incredibly important to make sure that you, as the realtor, are up to date on everything that's going on. It's obviously up to you how much into the technical stuff you really want to get. My job, like you said, Katie, is to be there as the in-depth knowledgeable person on this economic stuff, because people need that financial advice, that holistic financial advice in their life. It's not just about the mortgage, but the mortgage is an important piece of your overall financial health. And my job is to not only just get you the best rate and give the best service, but kind of advise as to how that complements your overall financial health, and making sure that the mortgage actually fits into your life and into your goals the way that
Hmm.
you need it to, based on your vision for your future. But
Yeah.
going back to your question, as the real estate agent, it's good to know enough to address the conversation with the client, especially if the client asks, like, when are we going to see rate cuts, or where are rates going, or should I buy now, or should I wait till rates come down? I'm sure everybody gets those questions. And as long
Hmm.
as you're knowledgeable enough to give, a good answer about that question, and say, if you want to get more in depth about it and talk about budgeting and affordability and that kind of thing, I'm happy to introduce you to my mortgage partner and let them take it from
Right.
there. And that's kind of what our strengths and our support should be.
Yeah, yeah, that's really important. It would you say the same thing for people, like, let's say we have clients or past clients that are at the point where they need to renew their mortgage? Is this a good time to also do that if they're looking for a 3 or 5-year fixed mortgage? Or how does that
Yes.
work?
So for the mortgage renewal, so you're asking,
Mhm.
like, when somebody's mortgage is coming up for
Yeah, if
renewal?
somebody's coming up in the next, let's say, 90 days, would this be a good time to make, like, to try to get a lower rate, to renew? Or I don't even know if that works that way or if they have to renew at a certain time.
Yeah, every lender's a little bit different. Some lenders will let you renew 3 months out or 4 months out from your renewal date without any penalty. Some of them will only let you do that if you're renewing with them as the same lender. Some lenders will let you move to different lenders. Every lender is slightly different, but it's never too early to get in touch, I guess, is a good
Yeah.
way to answer that question. Especially just for the advice piece and being prepared as to, what term would work for you. And our advice is always changing, especially with the volatility that we're seeing in the market right now. Our advice last month is different than our advice that we're giving today. Whether you're talking about 3-year versus 5-year versus variable.
Yeah.
And it comes down to your risk tolerance and, how much income you have coming in versus what your mortgage expenses are. If you're spending 40% of your income on your shelter expenses, then the conversation is going to be different than if you have a small mortgage, or you're a very high income earner or something like that. And
Right.
maybe you have a little bit more risk tolerance. So I think when you're coming up for renewal, the advice is very important. At the end of the day, what I address with my renewal clients is like, it's much easier to re-sign with your current lender, which means that
Mm.
there's nothing in it for me personally, but I still like to be able to give that advice and create that long-term relationship. And eventually clients realize, having a long-term relationship with a mortgage broker is a lot more beneficial than just kind of renewing with the same lender with whatever
Yeah.
rates they give you over and over again. And just making sure that that mortgage fits into your life, as opposed to just taking what you think is best, or taking what your family member told you should do, or that kind of thing. It really just comes down to the advice, and that's a lot of the value that we bring as well.
Mhm. So what's the difference right now between variable and fixed on average? Is it pretty big? Like if you're looking
Yeah,
at 5-year fixed? Yeah.
there is a large gap, and it's interesting because it's been that way for the last probably a year and a half, maybe even more. Traditionally, variable rates are a little bit lower than fixed rates. Traditionally, like, let's talk about 2021, for example, when people
Mhm.
were getting bottom dollar rates. You would get a fixed rate offer at 2% and a variable rate offer at 1.7%. Unfortunately, what happened to a lot of people is that they took the 1.7% because it was 30 basis points cheaper and the mortgage payment was a little cheaper. But then over the course of 2022 and 2023, they saw their mortgage payment jump up an incredible amount.
Yeah.
Of course, hindsight is 2020. It would have been better to take the 2%, and you'd still have 2% today,
Yeah.
which is
Yeah.
fantastic.
Mhm.
But again, when your mortgage comes up for renewal this year and you're moving from 2% to 5.5%, it's a bit of a shock as well.
Yeah.
But to answer your question, the variable rates today are actually higher than fixed rates because lenders are predicting rates to come down, and they want to make that money off of you in the near term. When rates come down in, say, year 3, 4, and 5 of that variable term, then you're saving on interest, but at least the lender made some money off of you in the first 2 years. So just as an example, using round numbers, we're seeing, a 3-year fixed rate at 5.4, but the variable rate would be 6.5, 6.6. So there's over a 1% difference right now between variable and fixed, and variable is higher than fixed.
Mhm.
The gamble is that you are paying higher interest today, the 6.5%, say, but over the next 5 years, rates are going to come down to the point where you would be saving money instead of taking that
Mhm.
5.5%. It is a risk. It is a gamble. I'm not saying variable is a bad decision, but for people who are more conservative and who really do need to budget, especially first time buyers who, they may not have a very high income and are spending a lot of money on this property, I would say fixed rates are where it's at for those buyers because it gives them that peace of mind and that security over
Yeah.
the next 3 or 5 years of knowing what their expenses are going to be. The last thing you want as a first time buyer is get to the point where you can't make your mortgage payments and you have to think about selling or asking family for help. And it's
Yeah.
not a good spot to be in. So that's my advice usually for first time buyers. At the
Mhm.
end of the day, I want to be able to educate my clients to the point where they're confident to make their own decision about it. That's
Yeah.
really my goal.
Yeah. I wonder if just with the volatility over the last couple of years, if more people will start opting for fixed. I think we've gone so long with such, even keel, nothing really happening that so many people have just gravitated towards variable. I've always like me personally, we've always done fixed. And I know we've probably lost tons of, oh, not lost, but we didn't do as well as the variable. But yeah, it's that risk tolerance, and you just hear so many stories about people that are just in really difficult positions and wondering how long. Like for you, do you think, I know you hear all this doom and gloom sometimes about people, like we're at the point where people aren't going to be able to hold on much longer. And if, as you said, the bond yields have gone up and rates might not go down as quickly as a lot of people think, do you think we're in, do you think there's, do you think we should be listening to the people that say, we're going to be in a lot of trouble in a few months because people are at that breaking point?
Yeah, it's a good question. I think there's a few things to consider. First of all, statistics are saying that Canadians saved a lot of money over COVID
Mm.
and that the average Canadian still has savings. I'm not sure how they conduct these studies, but apparently the average Canadian still has savings that they accumulated through COVID. And that's one of the things that, contributed to the real estate boom is that people saved up so much for their down payment that their affordability, that was one of the reasons why their affordability went up.
Yeah.
So I think the average Canadian still has a bit of a buffer, although we are seeing credit card debt increase and bankruptcies are increasing. So we are in a period where we're seeing these negative aspects of the rate hikes come up and maybe be more influential on the average Canadian.
Yeah.
The other thing to consider, though, is that when somebody got a mortgage in 2020 or 2021, they were stress tested at 5.14% or 5.25%, which means that according to our regulator, they would still be able to afford,
Mm.
on average, their mortgage payment if it went up to 5.25%, even though they were actually getting 2% on their mortgage. So today, fixed rates are at about 5.25, 5.5 on the 3 year fix. So when people are renewing or they have elevated variable payments, ideally they should still be able to afford it because they were stress tested at that amount 3 years ago, 4 years ago, whenever it was. I'm not saying you should. I'm just saying that was the idea of the stress test. And so it kind of did its job to a certain extent. I think if
Mhm.
people were buying in 2020 and 2021 and not stress tested and actually qualifying for mortgages that were at 2% and the qualifying rate was 2%, I think that we would be in a lot more trouble today because people would have way overextended themselves even more, maybe, than they actually did during the COVID period. So I think as much as the stress test gets some flack from people in our industry, it really did do its job and has enabled a bit of a buffer to put
Mhm.
us in a better situation than where we could have been today if there was no stress test over the last 3 years.
Yeah. Do you see any improvements that could be made or on the stress test? Do you think it's good the way it is? Do you see any ways that, could make it better?
Yeah, so right now we're stress tested at contract rate plus two. So if you're
Yeah.
getting 5.5% on your mortgage, you're being stress tested at 7.5. The
Yeah.
idea is that if rates continue to go up, you should be able to afford your mortgage up to 7.5%. There is a camp of people saying we should remove the stress test because it's too hard for
Yeah.
first time buyers to get into the market. But all that would do is increase people's affordability and push prices up further and increase competition in certain market segments, which is
Crazy.
really not what the Bank of Canada wants right now. They
Yeah.
don't want the real estate market to explode like it did in 2020 and 2021, and have more Canadians take on more debt, because that's not, that's not what they want to see for the economy at the moment. They want to slow things
Yeah.
down and bring down inflation and decrease average household debt and that kind of thing. I
Hmm.
think there are other ways to go about it. And, this is a little bit political, but like limiting foreign buyers was definitely something that they explored and, has probably had a bit of an effect on the market. Investors people who own 5, 6, 7, 8 properties, maybe there could be a way for the first time buyer to be able to get in there and buy a property instead of the average investor buying their sixth property or something like that. But I think there are other avenues to explore other than the stress test.
Yeah,
Personally, I think it was a good idea and that it did serve its purpose.
for
And what
sure.
we're seeing today, or the lack of negative effects that we're seeing today, could be attributed to the stress test.
Yeah.
I may be in
Yeah.
the minority there, but it is what it
No,
is.
I agree, because I remember when the stress test came out for everybody, not just time home buyers, and everybody was up in arms, like, how could this be? What are they doing? But look at the position we're in now, and could you imagine if people weren't stress tested 2 points higher than, that rate? Then we would have been, I don't know, housing market could have crashed. I don't know what would have happened, but people would have been in a very difficult position. So I
Yeah,
think it had a good effect. It served its purpose. It's not ideal, but it is what it is.
yeah.
Um, the other thing I've been thinking a lot about recently is, I saw a news article a few weeks ago talking about fixed. Is it fixed payment variable mortgages? I'm not sure the exact term. Yeah, but how many of those individuals, because of the rate increases, have started to get, their amortization will extend, because the payment monthly is not going up. It's actually just extending the amortization in the end. And some people have even gotten an infinity symbol on their mortgage statement, just because it,
Wow.
it got so out of control. Now, I don't know how many of those people actually are out there that got that. But can you talk a little bit about the difference between the two, and which one tends to be the more common type of variable mortgage?
Yeah, for sure. That infinity symbol is definitely not something you want to see on your mortgage. I
Exactly. It's
mean,
very apocalyptic.
yeah, no kidding.
Yeah.
Um, yeah, so there's two types of variable rate mortgages. We call them adjustable versus static. And so the static payment is the one that you were talking about, the fixed payment mortgage. And so essentially what that is you say, you get a rate, it's say we'll just use 6%. Here's your mortgage payment at 6%. Now, the mortgage payment is not going to change, but if rates fluctuate, the amount of the payment that goes towards principal and the amount of the payment that goes towards interest will change. So if rates go down, your interest portion will decrease and your principal portion will increase. So you're doing more, you're contributing more towards the principal as rates go down. Inversely, if rates go up, which is what we were seeing over the last couple of years, the interest portion increases and the principal portion decreases. So what you're talking about with people getting extended amortizations to 50, 60, 70 infinity years is the interest portion of the payment increases to the point where the entire payment is going towards interest. And now they're actually adding on to their balance every payment instead of decreasing their balance, because they're being charged more interest on every payment than the actual payment that they're making. And what happens with most lenders is that you'll reach a trigger point, which is a point when the lender has to request that you either increase your payment
Mhm.
or make a lump sum payment towards the mortgage in order to keep your amortization somewhat on track.
Okay.
Now, because of the unprecedented circumstances of the last couple of years, our regulator has allowed lenders to increase the amortization to, within reason. I guess infinity is not reasonable at all, but they've
Isn't it?
increased the amortization instead of demanding that the borrower increase their payment or make a lump sum payment. Because some people just aren't able to afford a bigger mortgage payment or aren't able to make a lump sum payment.
Yeah.
So they basically just extend the amortization and increase the balance as you're going through the mortgage. The problem is that when your mortgage comes up for renewal and you want to move to a different lender, you have to then decrease that amortization to at most 30 years in order to qualify with a different lender. And going from a 60-year amortization to the 30-year amortization is a huge jump in your mortgage payment, which
Right.
most people would not qualify for. And so they're kind of stuck on continuing with the same lender at whatever rates that lender is offering them and continuing on that amortization. So that was kind of the downfall of the
Mhm.
static payment. And the other one is the adjustable payment. So what happens is when rates go up, the interest portion increases and the overall payment itself actually increases. So your monthly mortgage payment is going to change with any rate announcements by the Bank of Canada. And at least with that type of payment, you see your mortgage payment go up every month. It's not like you're kicking this can down the road till one day you're going to be in a situation where you have a mortgage for 60 years, or the bank is demanding that you make a lump sum payment. At least you see your payment going from $2,000 a month to $2,200 a month, and you're actually physically, making those increased interest payments and being able to kind of adjust and budget your life accordingly, as opposed
Mhm.
to just one day being hit with this huge shock of a bigger payment, or the
Yeah.
bank demanding that you make a lump sum, or something like that. So there's pros and cons to both, and people who took a variable can be in a very sticky situation at the moment.
Yeah.
Most lenders, like I said, have been extending that amortization basically as in an effort to keep the borrowers in the green, and
Mm.
not have them go into an emergency or distressed selling situation. And that has also prevented, I think, a lot of distressed sales that people were predicting or are predicting, because the variable was allowed to kind of extend the amortization. I think it's a good thing that the regulator mandated that bank lenders enact these programs to help their borrowers get through this period, as
Yeah.
opposed to being forcing them to sell. So it's been working in favor of the consumer, and
Mhm.
ideally, most people can get back on track with their payments and their amortization.
Yeah. Yeah, because I mean, banks don't wanna have to go to foreclosure. Like, they wanna do what they can, I would imagine, to help their borrowers. It's in their best interest too. So,
For sure. I
yeah,
mean, the
it
bottom line is that if they remain a borrower, they continue to make money off of them with
exactly.
interest payments. So
Yeah.
yeah, you're right. Nobody wants to have the reputational risk either of,
Yeah.
saying like CIBC forecloses on 5% of their mortgages or something like that. Like nobody
Yeah.
wants any of that in the news. And so
Yeah.
they've been working towards kind of maintaining their borrowers, in the state that we're in.
Makes sense. Yeah. I know when you were a part of our team meeting a couple weeks ago or last week, we were talking about appraisals, and I think agents play not a big part in the actual process of appraisals, but definitely when it comes to assisting their clients in determining the best offer price and protecting them to make sure that they're not overpaying. What do agents need to know about appraisals, and how can they assist through the process to make sure that a client isn't going to get caught up with an appraisal that comes in low and obviously impacts the whole wholesale process?
Yeah, it's a great question. I think the bottom line is that you work very closely with your mortgage partner in any situation
Yeah.
where you think the appraisal may come in low. It's part of my job to make sure that the client knows, if your appraisal comes in low, here's what we need to have in place to make sure that this doesn't make the deal fall through. And
Yeah.
one of the things I will say is that, we need to work closely with your real estate agent to make sure that we are able to get the comps that we need.
Yeah.
In situations like today, for example, with condos, it's not a huge issue, but if you're looking at a freehold in the range of, I don't know, 1.5 to 2 million, that's where we're seeing a lot of issues, because
Mm.
over the last 3, 4, 5 months, the industry has been fairly slow. And so we don't have the historical comps. But when you're working with your buyer client and trying to determine a fair market value, you may not be looking at comps from the last 1, 2, or 3 months. You may be looking at, what's happening now, what's happened in the last week on that street. And if you're setting a new price point for that street or for that neighborhood, and it's very obvious that for your client to win this property, they need to kind of push that price point for that area, this
Mhm.
is when we run into problems, because the appraisal for the bank has to look at one comp from the last 30 days, one comp from the last 60, and one comp from the last 90. They can't look at 2 or 3 comps from the last 2 or 3 weeks. Unfortunately, they have to look at more historical comps, and they adjust slightly for, so if something sold for 90 days ago, they may adjust slightly for that comparable value. But
Right.
the story is that they come out more conservative. Just the bottom line is the bank appraisals are always a little bit more conservative. We can do what we can to try and get the value. We can always appeal an appraisal. Another strategy is to wait a few weeks and see if we can get a better comp in there and ask the appraiser to put a better comp in there. But if you have a 30-day close, for example, we don't have a few weeks to wait to get a better
Right.
comp in there.
Mm-hmm.
So if the situation arises where it's a possibility that the appraisal might come in low, we want to make sure the client has a backup plan to be able to put in the extra down payment that they need, whether it's, they take something from their investments or they get a gift from family, just making sure that there is a backup plan in place. And that just kind of goes into what is really important in your mortgage partner, which is them setting expectations properly with with your client. They never want to guarantee or promise anything because, let's be honest, nothing is guaranteed in our industry, right? At the
Mm-hmm.
last minute, things could fall through. We do our best as professionals to do as much due diligence up front as possible, but we can only do so much, and there are external factors that come into play sometimes. What we can do is prepare the client for, here's the worst case scenario, and are you able to still make things work in a worst case scenario? And I think setting those expectations for the client instead of just promising that everything is going to work out perfectly in the best case scenario is a very important part of my job.
Mm-hmm.
And it's something that I think, good mortgage partners are very good at, is
Yeah.
setting those expectations with those clients. And so that if you
Mm.
do hit a couple hurdles or a couple bumps in the road, it's like, oh, okay, Jacob told us that this might happen, and here's what we're going to do to kind of
Yeah.
circumvent it, or here's our plan B, so that we're still happy and things are still going to work out.
So true. If a client has the means to, financially deal with a situation where the appraisal comes in low, if they haven't been given that upfront advance warning of that, the situation and the conversation and the relationship it will be so much different than if a client is fully aware of this is what can happen. So it's just amazing. Like it's that psychology aspect of working with people, and how giving them that upfront advice and information can just make things go smoothly. Even if the appraisal comes in short, it will still go smoothly because the client, knew about it ahead of time. But the moment people don't know about it, it's like, doesn't even matter. I does like, I might have $100,000 in the bank that I could throw at this, but doesn't matter.
Yeah.
You didn't tell me about it, so screw you.
Totally, totally. And
Yeah.
I mean, as service professionals, we always want to, tell the client that everything is going to go smoothly and that we're going to do, we're going to be better than everybody else in the industry and provide them the 110% service and white glove service and all that stuff. But I think it takes real strength and real professionalism to say that sometimes things do
Mm.
go wrong, and here's
Yes.
what we can do if that case arises. And
Hmm.
like you said, as long as the client isn't like blindsided by something, you can still maintain that a good relationship and still make sure that the deal closes on time and everybody's happy with the transaction.
Yeah. So speaking of that, I think also pre-approvals is another aspect of the process that a lot of people maybe misunderstand or just aren't aware of. So how do you explain pre-approval versus an actual approval, and that whole process when people start looking for a home?
Yeah, it's a great question. And I hear from real estate agents sometimes that, so the client's pre-approved, right? So we
Mm,
can go in firm and there's going to be no problems, right?
mhm.
And it's not exactly the case.
Yeah.
When we do a pre-approval, the bare minimum that happens is that the lender reviews the application, which is just a bunch of information about the client, their residential history, their employment history, and their credit bureau goes into the lender with the application as well. Not all lenders will review this, but some lenders will review the application and they'll review the credit bureau. If they see anything questionable on there, they will point it out to us and say, hey, when the client has a live deal or when they have their offer accepted, we're going to need these issues to be addressed. So they inform me of any red flags that they might see on the application. What we do at Outline as an extra layer of due diligence is we pre-underwrite the file during the pre-approval stage as well on our side with our team, and don't just put the onus on the lender, because sometimes things are missed. Lenders can get very busy and they just kind of want to, get through the paperwork and that kind of thing. But what I do personally in the pre-approval stage is I'll collect all of the documents up front from my clients as well. So pay stubs, letter of employment, bank statements, all the stuff you need to send into the lender once you do have an accepted offer. And me and my team will look through all of it and use our expertise to make sure that there was no issues that are going to come up down the road. Because the lender won't review the pay stubs or the letter of employment or the bank statements in the pre-approval stage. They're just going to look at the application, which is the
Mm,
client telling me I make $100,000, so I put that on the application and send it to the lender. If
mm,
we don't have a letter of employment or pay stub that supports that $100,000, then it's not worth the application that it's written on. So what we do in the pre-approval stage is a whole bunch of upfront due diligence. And sometimes clients say like, oh my gosh, this is so much paperwork. And another point of setting expectations properly is I make sure my clients know like mortgages are a paperwork intensive process where they're
yeah.
going to ask a lot of questions and we're going to require a lot of stuff. And the
Mm,
sooner I review everything, the more likely to avoid any hurdles down the road. So what we do is we pre-underwrite all of our files in the pre-approval stage so that we know once the client has an accepted offer, we're not going to have any issues. And once they do have an accepted offer, that's kind of when the switch gets flipped to the firm approval. So the pre-approval turns into a firm approval. And then we go
mhm.
through all of the fulfillment of the documents with the lender, and they send the instructions to the lawyer and all this stuff that happens near closing.
Right.
But to go back and answer your question, the pre-approval is it's a very superficial analysis of the client situation. And
Mm,
the one thing that we don't have during the pre-approval process is the property itself. So we need
yes.
to make sure that the property isn't going to cause any issues with the lender, whether it's a condo and the status, the reserve funds aren't good, or there's an insurance claim or lawsuit in the building that can come up. So we want to make sure we do as much upfront due diligence on the property as possible before the client makes an offer, especially if you're in a situation where they need to go in without a financing condition.
Yeah.
That's when we need to make sure we have all of our ducks in a row and everything before the client makes an offer. If we have a financing condition, it gives us a little bit of a buffer to make sure that all of that's in order. And then in worst case scenario, we can't make it work for the client, we can back out of the deal within the financing condition period. And it also kind of goes back to the appraisal as well. If there's an issue with the appraisal and we order a rush appraisal within the financing condition period and it comes back too low and the client can't make up the difference with their own cash, we can back out of the deal without
Mm,
any penalty because we're still within that financing condition period. So
right.
ideally, the client has a financing condition. I understand that in some market conditions, that's just not doesn't make their offer competitive
Mm,
anymore, which is where where we are now, back to
yeah.
2021 again. So yeah, it's all about the due diligence upfront, and again, it comes back to setting the client's expectations properly.
Yeah. No, it's so true. And yeah, I get frustrated when the market starts to pick up because financing condition is usually one of the first things to get taken out of the offer. One thing positive I'm seeing is that even though there's multiple offers right now, I find most buyers are still sticking to a pretty conservative offer price overall. And so even though there might be 10 offers on a property, the final selling price is actually within, what you would expect given recent comparables. So I don't know if that will continue. I hope it does, because at least, things aren't getting out of control from a price perspective, because that's when I start to get worried. I remember, I think it was last year when there was a bit of a hold on rates and then the market started to pick back up, and it's just like, geez, like what is
Yeah,
wrong? Like I don't know what fuels it sometimes, but it can get us into some really challenging situations when that starts to happen. So at least people are at least being cautious right now with their offers. So
yeah,
hopefully
for
that will
sure.
continue.
It's interesting that you say that because I recently a lot of my buyers are saying, this is what I think the property is worth, and I don't want to pay any more than this much for the property. Even if
Yeah.
if the bidding war goes up to, 750, I don't want to go above 720 because I don't think the property is worth more than that.
Yeah.
Which is a totally different mindset than what we saw last year or the year before, which is
Yeah.
the client says, what's the maximum I can qualify for? Because
Yeah.
that's what I'm going to offer on the
Yeah.
property.
Yeah.
Right. And so I think buyers have developed a bit more of a sense of, they saw the market take a dip, and
Yeah.
somebody who paid 1.2 million for their house in 2021 and their house today is only worth 900,000 or a million.
Yeah.
They see their friends who maybe got into that situation like, you know what, I'm going to be a little bit more cautious with my bidding. And if we have to let this property go because it's going to go for more than what I'm actually comfortable paying for it, whether I can afford it, whether I can qualify for a higher mortgage or not, this is my, where I'm stopping. I don't know if you're seeing similar things, but I've been working with a
Yeah,
few clients who have that mindset of like,
for
I
sure.
don't want to pay more than this for the property. Whereas, in 2021, it would be like, can I offer more? Can I
Yeah.
qualify for more? Because that's what I'm going to offer as much as I can.
Yeah, I know. I know. And it's scary when it gets to that point. But yeah, no, most people I've been talking to, even even just in terms of the pre-approval amount, they might be pre-approved for a certain amount, but they're only comfortable up to a lower amount, which is good because they're definitely realizing like what they're comfortable with, what they want to put in from a mortgage. I think a lot of people want to have a life outside of owning a home. It's not just about, paying a mortgage every month. They want to have the ability to pay for other things as well. So
Yeah.
I think it's a more healthy relationship with finances and with the housing costs. So I'm hoping that continues. And maybe, I know a lot of people unfortunately got into some rough spots throughout the last couple of years, but I think this has also been a good thing in that it's been eye-opening for a lot of people in terms of, you can't go crazy. You can't just spend whatever on a house because it's not just what's going to happen in a month. It's what happens in 2 years when your home isn't worth nearly as much as what you paid for it, and life changes and you want to move, and all these other things. It's like a snowball effect.
Yeah, yeah, for sure. And I
Yeah.
think people's timelines have a lot to do with it as well. Like if
Mm,
you're buying a place that's like, oh, this is my forever home, or I'm going to be here for
yeah.
at least 10 years, it's a much different strategy than if somebody's buying their first condo and they're probably there for 2 or 3 years and then they want to upgrade.
Hmm.
It's definitely a different mindset going into how much you're willing to spend,
Yes.
and analyzing the market a little bit closer to see,
Sure.
where you're going to be in 2 or 3 years, because everybody wants to build equity in their property so that, they have something to draw
Yeah.
on, or a nest egg, or equity to use for a down
Exactly.
payment to move up, or something like that.
Yeah. I've seen this funny meme lately about just not making fun, but just talking about how baby boomers, with all their equity they've built up on their homes for, they spent like, $50 on a house and now it's worth $2 million. And meanwhile, all these poor first time home buyers just trying to get into the market. It's so different now, right? And I know interest rates were 20% back in the day and all that, but it's definitely a different time. Um, you know, I think as we progress in this industry, both from the mortgage side and from the real estate agent side, it's really about understanding that if you're in your 20s, buying a house might not be in the cards. It might be something that you're looking to do in your 30s or 40s because the market's changed so much. The
Yeah,
discrepancy between income and home prices has just skyrocketed. It's just such a huge gap now. So you can't be expected. And then the down payments on top of that, you can't really find a freehold home under $1 million these days. So to shell out 20%, that's not easy to find or easy to save for. So
for sure. Yeah,
yeah.
saving up for that down payment is a huge, huge roadblock, for a lot of first-time buyers. And
Yeah.
there's a new program that I've used a couple of times. It's called Arboro. I'm not sure if you've heard of them, but
No, I
they're
haven't.
they're a company that will partner with you on the down payment. And so if you put in
Okay.
10%, they'll put in 10% to get
Hmm.
you to a 20% down payment.
Okay.
It's still a new-ish program, and there's limited lenders that you can use to actually do the financing for that.
Okay.
And there's stipulations as to, they own a certain amount of equity, and when you sell, they're entitled to a certain amount of equity because they put in equity from the beginning. But
Hmm.
for some buyers, it does make
Yeah.
sense, and I've actually done a couple of deals with them, and it's a pretty smooth process, and they're still working on it. But if
Okay.
anybody has clients who are just like, down payment is their biggest hurdle and they don't have help from family, I would
Yeah.
say look into Arboro, or like get in touch and we can talk about it, because
Yeah.
I have experience working with them as well. And it's a cool new program that's out there, and they seem to be ironing out the kinks,
That's good.
and
Yeah.
working on their process. But the other thing I will say is I rarely come across a first time buyer who doesn't have help from their parents, whether it's
Mm,
co-signing on the
true.
loan, or gifted down payment, or both.
Yeah.
So,
Yeah.
if you're a first time buyer out there, or you have first time buyer clients that are just, they're having trouble, or they're feeling guilty about asking their parents for help, my
Hmm.
advice is, don't feel guilty.
Yeah.
They're there to help you.
Yeah.
That's what family is for, and don't let it
Hmm.
push your home buying dreams down the road because you're adamant about doing it on your own.
Yeah.
Accept that help. because
Hmm.
if you do end up having kids or whatever, you're going to want to help them in the same way. It's just about passing it down. And with the boomers who have $2 million of equity in their house and paid 11
Yeah, who
raspberries
can
for their
afford
house,
it?
like totally,
What's
that's
50 grand? Yeah.
exactly it
Yeah.
had like I'd say probably 80 to 90% of my first time buyers have help from their parents in one way or another. So it's a very, very common situation, and
Yeah.
I think that's the way a lot of people need to get into the market these days.
Yeah. Yeah. Just switching up that mindset. You're right. Yeah.
Yeah.
Very good advice. So I know that you have a ton of resources that you offer to real estate agents. So maybe if you can just, as we wrap up, just let people know about that as well as how to reach you if they want to work with you and refer for their clients to you.
Yeah, for sure. So you can follow me on Instagram. I'm Jacob underscore your mortgage broker. And if you want to see pictures of my kids, that's where you got to go.
I do
Um,
actually. It's
yeah, check it out. They're cute. But
Sorry,
yeah, we
that
send out.
sounded creepy. I don't want to see your kids from a creepy reason. We were talking about, you've got two young kids, and I'm sure they're, it's great to get to know people on a personal level as well. So,
Yeah, for sure. You got to stand
yeah,
out somehow. And let's be honest, the
exactly.
pictures of our kids are the ones that get the most likes. And I'm
It's
I'm trying
true.
not to be offended by it. My
Yeah.
educational videos, whatever,
I know,
but
two legs. Yeah. No,
picture
I'm
of
the
my
same
kids,
way.
hundreds of comments.
Yeah.
But we do put out a very informative, we call it our monthly outline. It's basically our newsletter, and we're always putting out new educational material, updates on the rate environment, big bank forecasts, like a ton of stuff that brings a lot of value. So I'm happy to enroll you for that. I'm Jacob at outline.ca if you want to send me a quick email, and I can add you to that. And if you just want to chat or you have any clients that just want to have a no obligation chat, I'm happy to do that as well.
Awesome. And you also have a lot of great resources like PDFs and guides and, sell first, buy first, first time home buyer incentives, all the guides. So, and you're able to, offer co-brand or whatever it is. So that's really, really helpful as well. And our
Yeah,
brokerage has definitely taken advantage of that.
yeah, I'm happy to. We do specialize in supporting our realtor partners in a different way than a lot of
Hmm.
other mortgage partners. A lot, you'll get messages from people on Instagram saying, "Hey, trying to ask for clients or referrals and saying that they provide the best service and the best rate." So we try to differentiate ourselves a little bit, and
Yeah.
um, we support our realtor partners with educational material that they can send to their clients. So they look like the experts, we look like the experts, and it's very polished and good looking stuff. So
Hmm. It
I'm
is.
happy to
Yeah.
co-brand that with you, put your picture and
Hmm.
your information on it, and you can send it out to your clients. And it's always good just to have a talking point, a
Yeah.
reason to get in touch as opposed to just like, hey,
Hmm.
are you looking to get into the market yet?
Yeah.
Here's some good resources. And it's like a no obligation kind of like, here's some information and bringing the value. And that's how we set ourselves apart on both sides. On the mortgage side, you guys on the real estate side, we have to stand out somehow. So I'm
Yeah.
happy to kind of chat with anybody who's interested.
Awesome. Perfect. Well, thanks, Jacob. We appreciate your time as always. Make sure to reach out. We'll also put in the show notes for the podcast all the ways to reach out to you as well. So, yeah, it was great to
Fantastic.
chat with you. You're
Yeah,
a wealth of knowledge.
no
And
worries.
I love
Anytime.
talking
There's a
about this
lot.
stuff. So it's nice when you're able to talk to it about, so I'm sure it's stuff that, you're always talking about, but you come at it from you explain it well, and it's really helpful to understand it from your level and from your perspective. So thank you.
Oh, thanks. I appreciate that. I'll tell you, my wife is tired of hearing about bond yield, so it's nice to chat with somebody who gets
No,
as excited
I
about it as
know.
me.
Awesome. Well, have a good day and we'll chat soon.
Okay, awesome. Thanks, Katie.
Okay, thanks. Bye.
Level up, level up, level up.